I have been seeing a lot of fear-mongering going on, especially from news headlines regarding the interest rate rises we are expecting to combat inflation. Some of the articles being posted are claiming that over 50% of participants in a mortgage application study provided information that was inaccurate or not faithful. Welcome back to my channel. My name is Reese, and in today's video, I'm covering the topic of liar loans, but more importantly, I'm going to provide some information for those who own a property with debt, or to those who are thinking about joining the property ladder and actually making a purchase. Let's start by defining what a liar loan is. Essentially, it's when people knowingly provide inaccurate financial information to a lender when applying for a loan. Income, existing debt, employment history, money spent on regular expenses, and what liquid assets you have are all common parameters which feed into someone's ability to secure a loan from a lender. Misrepresenting these parameters may sway the amount of money that someone might be eligible to borrow. And this might seem like a great opportunity to secure more funds to put towards the purchase of a property that might not be within their affordable price range. The problem that comes into play is when a borrower receives an approval on a mortgage that exceeds their ability to make those repayments. Since 2008, in Australia, anyone who applies for a loan undergoes what is known as a serviceability test, or a serviceability buffer, where the lender would calculate the required repayments at 3% higher than whatever the current interest rate is. If the person applying for the loan can make repayments at that serviceability buffer level, then they are more likely to receive that money from the bank. Now, before measures like this were introduced into the home loan application process, money would be handed out to people who couldn't necessarily afford to pay their mortgages if interest rates rose too quickly. And loans like this were a contributing factor to the 2007-2008 global financial crisis. I've actually made a video talking about that topic alongside what the serviceability buffer is and how it works, and I've linked those videos down in the description below. If you think that you'd be interested in learning more about them, feel free to use those resources as you wish. And now would be a really good time to just quickly hit that like and subscribe button. It really does help the channel grow. I really do appreciate the support, and it does not go unnoticed. Anyway, back to the point that I was trying to make. Ever since these lending criteria or lending measures were introduced, it has somewhat reduced the amount of money that people are able to borrow for the intention of purchasing a property. So as a solution, it seems almost as if people have decided to tweak their application to make themselves look more favorable and actually be able to secure a loan, whether they're trying to borrow up to their necks or they're even just trying to be approved for a loan in general. So now for my thoughts, starting with people who provide false or misleading information on a loan application. Shame on you. Shame, shame, shame. Just kidding. I understand why people do this. If I wasn't getting fact checked or pulled up on the information that I was providing and it was going to make me look more favorable on a loan that I'm trying to secure, I could completely understand why someone would go down this path. The other aspect of this as well is that there's rumors going around that some lenders have encouraged this behavior as well, again to make them look more favorable on their application, which then makes the lender secure another loan, which helps them meet KPIs. And at the end of the day, everyone in that process is kind of winning because the person's gaining the loan and the lender's gaining someone's business. The problem is that the lender is not going to be the person who falls victim to the consequences of this behavior. It's going to be the person who borrows that money to begin with. At the end of the day, the borrowers, the ones who provided this false and misleading information, are the ones that are going to be hit the hardest. They're going to experience the impacts first compared to someone who didn't lie in their application and borrowed an amount of money that is based on the calculations taking place, which has a bit of redundancy built into it. Now, just to be clear as well, while I do agree that some of the impacts might flow down to the more stable homeowners, the people who have, I'll say it in quotes, done the right thing, I do believe that they might somewhat be affected by the impact of the others who have done the wrong thing. I do not believe that this will trigger or be the sole cause of a housing crash, if we even have one at all, which has been looming for a long time, depending on when this video does get released. But I do not believe that will be the sole reason from people providing misinformation and borrowing too much money for that purpose. Anyway, the moral of the story is to understand the amount of debt you can take on and actually afford to service. It is super important to provide as much information as accurately as possible to your lender when going through this application process, because these guidelines and serviceability checks are designed to protect the borrower. In the instance where interest rates rise too quickly, the cost of living goes up due to things like inflation, they are serviceability buffers. There's no other way to put it. They are designed to protect the borrower. I'm also just going to touch on what I believe we might see happen with the housing market if interest rates rise significantly and quickly as well. That 3% serviceability buffer is great for many whose financial situations haven't changed all that much since they borrowed that money, because it gives them a little bit of wiggle room for those who purchased within their means. In that scenario, if interest rates do rise over time, it should only mean that for those who are in a stable position will put less into savings, as more of their liquid cash will be absorbed by the loan. In my opinion, the real issue that will come into play will be for anyone who's decided to purchase since the beginning of the pandemic and who has now had a child, maybe has fallen pregnant and isn't going to be working full time anymore to continue servicing that loan, or has lost their job due to the pandemic. That 3% serviceability buffer is effectively gone in that situation, and I can only imagine that some people would already be feeling the heat. Interest rates haven't risen that much at the time of recording this video right now. However, I do believe that they will in the near future, and I guess this statement is one to come back to and see how it aged like milk in the near future. To summarize, the main people who are at risk here are anyone who has lied on their serviceability test, or anyone who has increased their spending significantly since their serviceability test was carried out, if they have not stayed on top of it and continued to grow their earnings or sources of income at the rate that their spending has increased. What this looks like from a long-term perspective is really hard to foresee. However, there is already a decent rate rise priced into most mortgages, being that 3% serviceability buffer. To wrap today's video up, anyone who has purchased a property since after the GFC have purchased in a time of much stricter lending criteria, and apparently Australians are well ahead on their mortgage repayments, and I think that that can be attested to things like COVID making people work from home, being able to save more money and spend less. If you look at some statistics like how much credit card debt has been paid off within Australia over the past couple of years, it is quite significant and it's really impressive. So it's a stat well worth looking into. I'll give you some homework for today's video, go dig that up yourself. But the point that I'm trying to make here is that I wouldn't be panicking too much with a few interest rate rises. Most people should be able to afford it as long as their serviceability buffer, the tests and information that they provided on those loan applications are somewhat accurate, even if they were skewed a little bit. Simply put, I do not believe that a large number of people are going to default on their mortgages simply from interest rates rising. If unemployment rises significantly, that is when I would start paying much closer attention to what's happening, because if income stops, it means that they are not able to make their repayments using that income, and eventually they will chew through their savings until the point of them actually having to default on their mortgage. That is when you want to start paying attention, and that is when the fear mongering is really something to be paying attention to. If you do own property, I would definitely be making sure that you keep your budget well under control. You make sure that your emergency fund is definitely topped up, and be putting as much spare money into an offset, if not redraw account, to relieve any pressure from future rate hikes. If you are someone who is looking to purchase property in the near future, do not lie on your application, and do not borrow, or try really hard not to borrow more money than you can easily sustain in terms of your repayments. And that is pretty much all I have for you in today's video. I hope it was insightful. I hope that you learned something. If you did, please hit that like and subscribe button down below. It really does help the channel grow, and I really do appreciate the support. But overall, this is a topic that is definitely worth understanding. It is a topic or a discussion that you should be having with your partner if they do not understand and you do. It is something that the fear mongering right now is probably unjustified, but it could very easily become justified in the near future. And it's something that you don't want to be part of that narrative of the people who are going to be defaulting on their mortgages. You want to have a plan, you want to be ready to go, and you want to make sure that you are not affected overall in the worst possible ways out of what is going to shift and change within our financial systems here in the country, let alone the world. And I'll leave you there. Have a good day, have a good week, and as always, I will see you in the next one. Bye for now.